Welcome to today's session hosted by Enact Mortgage Insurance, where we're going to be talking about removing barriers to mortgage credit. Before we get started, I want to talk a little bit about what we do as mortgage insurers. It is our goal to help people achieve the dream of homeownership and keep them in their homes. Many people can't afford large down payments, and we stand in the gap and make it possible for individuals to get into a home for as little as 3% down. We are very proud to be a part of an industry that collectively helped over 2 million low down payment borrowers in 2020. However, we recognize this is not enough because not enough of those borrowers were Black homebuyers. Homeownership is a critical source of wealth accumulation in the United States, yet homeownership rates for Black households remain significantly lower than those of white Americans. Existing policies and programs have made little progress in narrowing the gap, and without corrective action, it will only continue to widen. So today in this session, we're going to discuss opportunities particularly within the secondary market and within the congressionally chartered government-sponsored entities, which you'll hear us refer to as GSEs, which includes Fannie Mae and Freddie Mac, to replace these barriers with a mortgage credit system that's going to have tangible solutions to advance Black homeownership. We also have a special guest today, and it is my honor to welcome Chairman Emanuel Cleaver from my home state of Missouri, where he's serving his 9th district, or his 9th term representing Missouri's 5th district. He is a member of the House Financial Services Committee, and important for our conversation today, he chairs the Subcommittee on Housing, Community Development, and Insurance. Congressman Cleaver also serves on the House Committee on Homeland Security and a member of the Select Committee on the Modernization of Congress. Chairman Cleaver is a leader and an expert in Washington on housing and works hard to make sure housing is more affordable, fair, and equitable for all, and we are so lucky to have him join us today.
Thank you, Madison. And thank you to Enact for inviting me to participate today and for convening a session on this important topic of Black homeownership. One of the most important forms of wealth for working and middle-class families is home equity. Of all the assets that lead to wealth, homeownership is often the first step for many Americans in building wealth. It is also a tool for disrupting intergenerational cycles of poverty. Homeownership is the primary tool for building wealth in the United States, especially for Black households. But homeownership has failed to benefit Black homeowners as much as it has benefited non-minority homeowners. According to U.S. Census Bureau statistics, the gap in homeownership rates between Black and white Americans grew over 30% last year, a level higher than it was, believe it or not, in 1968 when the Fair Housing Act, which outlawed housing discrimination, was first passed. Black homeownership has declined for much of the past 20 years toward historical lows, while homeownership rates among white households has increased toward record highs. The National Community Reinvestment Coalition notes that in order to increase the Black homeownership rate to 60% by 2040, the United States would need to produce 165,000 new Black homeowners annually over the next 20 years. What is clear to me is that the only way to reverse trends which have not improved over the past 50 years is to enact bold and unapologetic action. What we need is a partnership between private corporations, banks, and government agencies committed to increasing Black homeownership and wealth. The factors that have contributed to Black homeownership challenges include: 1, government housing programs that were historically designed to provide home ownership to white, middle-class, and lower middle-class families. 2, the Federal Housing Administration, which refused back in the day to insure mortgages in and near African-American neighborhoods. 3, redlining in the public-private sectors. And appraisal disparities which were systemic, widespread, and coordinated. Only a level of energy equal to the energy put into discriminating against Black folk in housing can begin to turn the tide. Financial Services Committee, under the bold leadership of Chairwoman Maxine Waters, has proposed groundbreaking legislation to increase Black homeownership in the United States. The down payment towards the Equity Act of 2021 would help address U.S. racial wealth and homeownership gaps by providing $100 billion toward down payment and other financial assistance for first-generation home buyers, many of whom, as you might expect, are African Americans due to historic discrimination. Down payment requirements remain one of the greatest barriers for many first-time home buyers, and this bill helps ease the financial burden. According to the Urban Institute, targeting down payment assistance to first-generation home buyers could reach 6 million Americans who are disproportionately Black and brown. I'm also very proud to have introduced the Real Estate Valuation and Improvement Act of 2021, which would establish an interagency task force to review and remove barriers to equitable real estate valuation standards and to provide federal grant funding to facilitate greater diversity in that profession. This bill would seek to ensure that once minority communities build equity in housing, they do not lose that equity due to bias in the appraisal industry. I was so pleased when President Biden announced the creation of a HUD-led task force on appraisal bias that I proposed. I look forward to continuing my work to move the legislation through Congress that would provide additional dollars and support for the work they are now doing. There's no shortage of work to do in the housing space, and we have a limited window to accomplish as much as possible. We now have an opportunity to make progress on housing, which comes only once or twice in a generation. I thank the distinguished panel for coming here to share how we can continue to remove barriers to mortgage credit, how we can consider alternative scoring models and practices, and how we can leverage the GSEs to expand Black homeownership and vigorously enforce fair housing laws. Again, I'd like to thank Enact Mortgage for leading this discussion today, and I look forward to the resulting recommendations.
Thank you so much, Congressman Cleaver, for those remarks. I'm now excited to begin the panel discussion, and it is my pleasure to introduce our two very distinguished panelists today. I'll start with Vanessa Gale Perry. She is a professor of strategic management and public policy at George Washington University School of Business and a non-resident fellow at Urban Institute's Housing Finance Policy Center. Her research examines consumers in financial and housing markets, marketplace discrimination, and public policy, and has been published widely in scholarly journals and practitioner-oriented outlets. Professor Perry served under the Obama administration as a senior advisor to the Secretary of U.S. Department of Housing and Urban Development, and as an expert appointee at the U.S. Consumer Financial Protection Bureau. Before joining the faculty at GW, Professor Perry was a senior economist at Freddie Mac. Professor Perry holds a BA in philosophy from the American University, an MBA from Washington University in St. Louis, and a PhD from the University of North Carolina at Chapel Hill. Thank you so much for being with us today. Next, we have Michelle Arnowitz, who is a civil rights attorney in private practice in New York and a founder of the law office of Michelle Arnowitz, PLLC, a civil rights law and consulting firm focusing primarily on fair housing and fair lending. She recently served in the Obama administration as Deputy General Counsel for Enforcement and Fair Housing at the U.S. Department of Housing and Urban Development. Prior to that, Arnowitz was Deputy Solicitor General for the State of New York, Associate Counsel to President Clinton, and a trial attorney at the U.S. Department of Justice Civil Rights Division. She was an adjunct professor for the appellate advocacy at Howard University and a judicial law clerk at the U.S. Court of Appeals in the Ninth Circuit. Michelle also worked as a summer associate in the NAACP Legal Defense Fund, and she graduated from Stanford Law School and Yale University. Thank you, Michelle, for being with us today. So before we jump into today's discussion and subsequent research that will follow, I just want to talk about our focus. We're going to be talking, as previously discussed, on removing barriers to mortgage credit, but we also are going to specifically zone in on the secondary market and the government-sponsored entities. We believe this is critical as the provision of mortgage credit are heavily relied on by the GSEs to provide mortgage credit nationally. Many people, which rightfully so, focus on the front end and origination side of the market, but we wanted to focus on the foundational level because a lot of what happens within the secondary market drives the primary market. So with this in mind, Michelle, can we talk about increasing or increasing the monitoring and enforcement of fair housing requirements? A lot of us have heard the very sobering fact that how the homeownership gap is wider today than it was in 1968 when the Fair Housing Act was passed, which just never gets easier to comprehend how that's even possible and how we are here today. But something that I have noticed in these conversations that we are discussing a little bit less often is exactly what tools or an oversight ability were given to us from the Fair Housing Act when it was passed. So can we talk about what are the main tools for enforcing non-discrimination policies within the secondary market and how they can be enforced?
Thank you, Madison. I'm happy to talk about both of those questions. So the primary federal statute that prohibits discrimination in mortgage lending is, of course, the Fair Housing Act of 1968, followed by Equal Credit Opportunity Act, which was enacted in 1974, known as ECOA. Both Fair Housing Act and ECOA prohibit discrimination in mortgage lending, but I'm going to focus on the Fair Housing Act today because it has more direct application to the loan purchase policies we're discussing. The Fair Housing Act is an exceedingly broad civil rights statute. It prohibits discrimination based on 7 characteristics: race, color, national origin, sex, religion, familial status, and disability. But since the topic today is Black homeownership, my examples are going to focus on race. But the statute is much broader, as I have explained. So with respect to lending, which is our focus, the Fair Housing Act prohibits discrimination in all aspects of the primary and secondary mortgage market, including not limited to marketing, originating, insuring, servicing, and purchasing of home loans. The main tool for enforcing non-discrimination in lending context is the disparate impact analysis, which applies under both the Fair Housing Act and ECOA. So the disparate impact analysis is far from new. HUD, federal courts, and others have been applying the disparate impact test for some 40 years or more. Its validity was affirmed by the Supreme Court in 2015. I'm sure everyone's heard the term disparate impact tossed around in the news, in the papers, but what is it? So the disparate impact test is a mode of comparative analysis that can be used to identify policies that on the surface apply to everyone equally, then in application disproportionately and unnecessarily exclude or burden borrowers of one race or other protected characteristic. In other words, a mortgage practice that burdens Black borrowers unequally compared to white borrowers is not per se illegal, but it is suspect under the disparate impact doctrine and requires justification. An example of facially neutral lending practice subject to disparate impact review are credit thresholds, sometimes called a credit cliff. So here's an example. A lender investor imposes a DTI threshold of 43 for originating or purchasing mortgages. That requires justification where it disproportionately excludes Black borrowers. So generally, the excessive layering that feminists are discussing today falls squarely in this category of facially neutral practices with racially disparate impacts requiring justification to survive disparate impact review. So now I'm going to get to your question of how do you enforce this medicine? So roughly, the GSEs are private businesses, don't forget. So even under conservatorship, anyone can sue them in federal court when they feel like they have a fair housing claim. But that hardly seemed like the most practical or effective way to ensure non-discrimination in the secondary market. Fortunately, HUD gave HUD the primary role and specific authority to monitor and enforce fair housing compliance by the GSEs. So specifically, HUD has the power to review the GSE's underwriting and appraisal guidelines, and generally to ensure that loan practices are in compliance with fair housing laws. So among other things, Congress empowered HUD to access the data it needs to identify systemic fair housing issues with GSE loan policies, and gave HUD the legal tools to redress them. If HUD finds a violation, among other options, it can issue a charge of discrimination under the Fair Housing Act, after which, if not resolved informally, the charge will be adjudicated through HUD's administrative process or prosecuted by DOJ in federal court. But in practice, HUD's present concerns with the GCs have been addressed informally. So I can't promise that eliminating disparate impact discrimination will eliminate Black homeownership gap, but I will say there's no chance of eliminating the gap without eliminating the dual banking system and the policies that maintain and magnify the long history of race discrimination in home lending.
Perfect. Thank you for that information, Michelle. Just to kind of go further, talking about just enforcement of fair housing, affirmatively furthering fair housing is another tool that we can use to fight discrimination. What agencies does the affirmative mandate to dismantle the segregated system apply to, and how does that operate?
Well, let me first explain what it is, and then I'll tell you which agency it applies to. So the federal government's complicity in creating and maintaining housing segregation and the dual mortgage market led to a legal mandate not only to ensure non-discrimination housing, but to affirmatively further fair housing, or people refer to that as AFFH, which is hard to say. So because of that, I call it the affirmative mandate, which a lot of people refer to as an easy kind of term. So the affirmative mandate, enacted as part of the Fair Housing Act, was placed on the federal government because of the role it played in segregating the banking and housing markets through, for example, FHA redlining, to name one of many examples. So the mandate applies to the federal financial regulators, such as the Department of Treasury, FHFA, which is the Federal Housing Finance Agency, which regulates the GSEs, the OCC, the CFPB, which is the Consumer Finance Protection Bureau, and HUD, which houses the FHA insured mortgage program. But generally, the mandate applies to any federal department or agency that administers programs or activities related to housing urban development, which includes home lending. So HUD, as lead housing agency, plays the coordinating role with respect to the other agencies to ensure the affirmative mandate is carried out. HUD has enacted its own FH regulation, which has been in the news, so you may have seen reference to it. But I do want to point out that applies only to HUD's programs, only HUD's fund recipients. That's one way HUD, but not the only way HUD, tries to ensure its funds will not be used to discriminate, but instead to affirmatively further the purposes of the Fair Housing Act to eliminate housing segregation and discrimination. FHFA, by comparison, passes its obligation onto the GACs through FHFA's regulatory and a supervisory role, and also their charters. So at bottom, the housing regulators, including FHFA, they can't turn a blind eye to, or even worse, encourage, facilitate, maintain, or expand the dual banking system that began with the regulator instituted redlining and continues with modern banking policies that have the effect of widening the racial homeownership gap. Thank you.
Perfect. Thank you so much. And I think this sets the stage really well for our next topic, because you touched on the dual economy, which eventually exists in a lot of places in America, and one of them is credit. And so I think it's a great example of the discrepancies that you can see when you break down data by race, which is what I'd love for us to talk about, Vanessa. Credit has historically been a challenge for consumers in minority and low-income communities, and these patterns are definitely reflected in the credit data. And as a result, they are then reflected in credit scoring models and then reflected in underwriting models. And so it's definitely a ripple effect. So can we just talk about the lack of representation Black households often experience? And so not only just having low scores, but often they're not represented at all and are referred to in the industry as invisible or unscorables.
Sure. Thank you for that question. Of course, I get the difficult question, but I'm delighted to be here and excited to be able to share some of these thoughts. So you asked about credit challenges. So many of the credit-related challenges faced by Black consumers result from cumulative disadvantage and the long-term effects of limited access to financial services, redlining, predatory lending practices, and other sort of manifestations of discrimination over time. Mainstream credit scoring models, the ones we rely on, like, for example, FICO, is this sort of standard model, rely largely on credit bureau data in the mortgage underwriting process. And these are particularly an issue because credit scores are a large part of risk-based pricing, which the enterprises use. And they're also part of what we talked about, what we call overlays. And actually, Michelle alluded to those in the context of debt to income ratios. But overlays are basically minimum credit score cutoffs that are imposed. And so these credit challenges become a real problem. Existing credit scoring models have a negative and disparate impact on Black households because Black households are less likely to utilize traditional lines of credit, like credit cards, auto loans, etc. So Black households are more likely to have missing or sparse or thin credit files. We call people with no credit scores or no credit files at all, we call them credit invisibles. And people who have a few traditional credit records, but not enough to comprise an actual credit score, those are known as sort of unscorable. When you combine both the unscorable and the invisible consumers who are represented in Black households, you've got 28%, which is a really, really large number. That number is only 15% for white households. So this, becomes a sort of real issue. Another issue is with respect to the risk categories that get assigned for many Black households. So many Black households are more likely to have credit scores that fall below 620, also below 700. Both of these categories are categories that are considered higher risk by lenders and for which higher interest rates are charged. So because credit bureau data traditionally has excluded regular payments such as rent and utility bills, our more mainstream credit scoring models don't really provide a comprehensive picture of the household's financial obligations or ability to meet them. This explains why median credit scores for Black consumers are significantly lower than they are for members of other groups. And we show that in this chart here. These data we borrowed from the CFPB, who report that approximately 53% of Black households fall into high-risk credit score categories, say that is below 700, compared to 30% of white households. And 38% of Black households have a credit score below 620, which is often used as a minimum credit score cutoff. The fact of the matter is that any restriction based on credit score is going to have a more significant impact on Black households.
Yeah, that data is just staggering. I mean, when you think about 53% below 700 and then an additional 28% that are unscorable and invisible, I mean, that's very significant. Just kind of continuing the topic of credit, what do you think are some possible solutions to these issues, and how can we make improvements to our current credit scoring model?
So also a great question, and I'm pleased to report that actually help is on the way. There have been a number of initiatives on the part of both credit scoring companies and a number of other parties to try to innovate in the space of credit scores, to expand credit scores, to include alternative data that traditionally have not been included. So, for example, I believe just yesterday, Fannie Mae has announced that rent payments, they're going to allow rent payments to be incorporated in their models, which is a really big deal because rent payments are far more common, but there's traditionally no single or consistent way to track rent payments because they're not necessarily collected on a regular basis. So they're going to use aggregated banking data, that is cash flows based on bank statements, which is an example of the kind of change that is really going to make a difference in expanding the availability of credit scores for Black consumers. There are experiments being conducted and research being conducted on other elements too. So we have credit proxies, which include things like rent payments, but also utilities and telecommunications payments. And there's research looking into expanding credit scores with those kinds of data. There's aggregated banking data, which is data from bank statements that can capture flows of funds from checking and savings accounts in and out. And there's evidence that those can be used to predict repayment behavior, which is what credit scores really do. And then there's a kind of third category of data that are being explored. And these are non-financial personal data. And they include things like social media activity and any other kind of data that can be extracted from a consumer's digital footprint. So in China, for example, there's a social score that actually captures social media and rates consumers based on the reputations of members of their social networks. Now, we don't think that that kind of thing is going to fly in the United States. That certainly runs into a number of ethical and legal concerns, as do something that has also been proposed, which is GPS location. Well, the problem with GPS location is it could be used to infer all kinds of personal and demographic details like race and gender. So those are both legal and ethical violations, and may not necessarily align with our societal values for diversity and for privacy, quite frankly. But I mentioned them because there is research being conducted looking at how data, this sort of non-financial data, could potentially enhance the availability of credit scores. So FICO, Vantage Score, there's a number of other companies that are looking into these kinds of additions. And FHFA is working with the enterprises to find ways to run pilots with alternative credit scores, because one of the other issues is that the FICO score is kind of embedded in our existing mortgage-backed security system. And so in order to be able to use an alternative score, it's going to take some real modifications, system modifications in order to make that happen. But as I mentioned, FHFA is working with the enterprises on doing this. And so we are hopeful that very soon we're going to start to see some expansions in credit scoring.
Yeah, it's definitely exciting to see the innovations happening in the credit space. I think that some of the social media stuff and GPS is very interesting, to say the least. But I definitely think that the opportunities there are great, and I think it's an absolutely essential way to expand access to mortgage credit and beyond. And really, talking about credit was going to, as we talked about earlier, there's definitely a ripple effect. And so as we continue our conversation, we'll see just why it's so important. Because credit scores feed into, as you mentioned, Vanessa, risk-based pricing at the GSEs. They have something we're going to dive into later, loan level price adjustments, and also credit overlays. But before we jump into the policy-specific things at the GSEs, I just want to start with a brief background to talk about the GSEs and what makes them so different than just a regular public company. They have they are congressionally chartered, and within their charter, they have a duty to serve underserved borrowers. What is this duty to serve? And can you talk about why it was created and how that makes them very different than just a traditional company?
So, as you mentioned, the duty to serve is a regulatory requirement that both of the enterprises have to provide liquidity in the mortgage market to underserved borrowers. And the definition of what they mean by underserved, or the way these resources are directed, sort of has changed over time. And the regulation is set up so that it can be sort of, all these requirements can be altered over time. Currently, duty to serve requires Freddie Mac and Fannie Mae to serve borrowers in three sort of segments of this market: manufactured housing, affordable housing preservation, and rural housing. And so those are the areas that are of their main focus at this time. So I'll say a couple of other things about what makes them different. So even when these entities were private and shareholder owned, they were sponsored by the federal government. They were backed by the federal government, and that enabled their access to sort of low cost leverage, that is, low cost ability to borrow funds. And they also got some preferential tax treatment. So they've been in conservatorship since 2008, since the 2008 crisis. So what does that mean? It means that basically the federal government has taken over the role of the shareholders for the time being. And we thought that was going to be temporary, but it's been going on. And there have been a number of proposals, as you know, about how what might be the next step. Doesn't look like they're necessarily going to become fully private again in the near future. But each has a statutory obligation to fulfill these requirements. One of the other things I will mention is that these requirements do not mention serving Black or other disadvantaged groups, although they do explicitly refer to mortgage purchases for low and moderate income families, and access to mortgage credit throughout the United States, including things like central cities, rural areas, and other underserved areas as part of their institutional purpose. But one of the things that we feel very strongly about is that duty to serve could be used as a mechanism to direct more purchase activity towards mortgage loans to Black borrowers, from Black borrowers. And so that's why we think duty to serve is something worth really thinking about more carefully.
Yeah, certainly. And I think one of the aspects that's so critical is whenever we look back at the history, we see that the GSEs the pool of borrowers that were Black in the conventional market wasn't always the low level that it is today. And so one of the things I think we should highlight and just kind of discuss a little bit more is, despite this obligation, which you laid out really well, then the lack of this explicit obligation to serve Black borrowers, although like you said, they have the low and moderate income obligation, the share of conventional loans within the Black borrowers eligible for purchase by Fannie Mae and Freddie Mae is significantly lower than the proportion of FHA insured loans made to Black borrowers. And so that is, there's a stark contrast there whenever we look at the data, which I know you're going to dive into, but what do you believe is a driver of this? And is there risks associated with having minorities concentrated on the government side within the FHA and Ginnie Mae?
Sure. Well, we're certainly willing to provide our opinions on that. I would say that the two key drivers are overly restrictive risk-based pricing policies. That's one. These have been overly restrictive risk-based pricing policies, including loan level pricing policies. And overlays. Again, overlays are the cutoffs that we referred to earlier. And these have been in place since the 2008 crisis. And so I think that they were put in place in reaction to the crisis, because at the time, we didn't fully understand how the crisis with this in the subprime mortgage market came to be and what the subsequent effects were going to be. So I think those two are key. I'll mention something then about FHA, which is what you asked. I'm going to share my screen once again. So a large proportion of Black borrowers either can't meet the underwriting standards that are in the conventional market, or they resort to FHA or VA mortgage loans. Because FHA and VA mortgage loans are more expensive over time. So, I want to be clear, they're perfectly viable options and do a lot to advance lending, particularly for minority borrowers in the US, but they are more expensive over the life of the loan. So this reduces the equity that Black borrowers are able to accumulate over time. In fact, Michelle and her co-authors published a paper last year that found that over time, Black borrowers lose approximately $31,000 in retirement savings as a result of having to pay more of these costs, to bear more of these costs over time. So that's the risk. Not only that, the FHA and VA insurance funds, there is a limit to the amount of sort of the size of these funds. And quite frankly, no one thinks that it's reasonable for them to bear the entire responsibility for expanding lending to Black and Latinx borrowers. The conventional market, again, has a duty to serve that should encompass these borrowers as well.
What are some ways that we can expand Black homeownership within the conventional market, within the GSEs, to address this issue?
So I think one thing that we could do and should do as soon as possible, the enterprises really need to eliminate risk-based pricing. That is, replace this loan level pricing with average pricing. So let me just share what that is. So this loan level pricing occurs because, and I'll talk about that in a second, so I'll come back to that, but that's one. The second thing is to eliminate these credit overlays. So that is specific cutoffs on FICO score and specific cutoffs on debt to income ratios. These have a negative and disparate impact on Black borrowers. And quite frankly, they're unnecessary given the sophistication of the underwriting models that are in place that rely on multiple variables simultaneously. So we just don't need those cutoffs. And I think these two would be really important steps towards ethical and socially responsible approaches to eradicating inequality.
Also, so when we're talking about the loan level price adjustments, which is the credit-based pricing that the GSEs use, can you talk a little bit about how these started and if you think they're still necessary today and why that would be so beneficial to eliminate for particularly for minority borrowers?
Sure. So these loan level price adjustments, and that's kind of the catch-all term, even though Freddie Mac actually refers to them as a credit fee in price. But they are one-time upfront payments that the enterprises actually charge the sellers of the loan, so the lenders, the loan originators, that are then added to the interest rate that the borrower pays. So they directly increase the rates that borrowers have to pay for mortgage loans. I believe they were put in place in response to the financial crisis and all of the uncertainty that was going on with respect to subprime mortgages. At the time, the enterprises were facing deteriorating housing market conditions. Actually, everybody was facing deteriorating housing market conditions. And it really wasn't clear how well of a handle we had on the likelihood of prepayment or default for mortgages. And so these were put in place at that time. I'm going to share my screen again because I love charts to show you how stark of a difference in interest rates we're talking about. Sorry. You can see here that Black and Latinx borrowers pay higher rates due to risk-based pricing, significantly higher in the conventional market. So conventional market are the three colored bars to the left, and Black borrowers are in teal, Latinx are in purple, and white borrowers are in orange. And these are the average interest rates. So you can see that the interest rates are significantly higher in the conventional market than they are in FHA or VA markets. So that being the case, you can see then why Black and Latinx borrowers tend to be more likely to take FHA and VA insured mortgages. It's cheaper. So they either may not be able to qualify, but even if they did, it wouldn't sort of make very much sense to go into the conventional market unless they could do so at a competitive rate, given the profiles, the risk profiles that are relied upon, typically higher, lower credit scores, in many cases, higher debt to income ratios, and lower down payments. And since many Black borrowers find themselves in that situation, the conventional market's pricing is very restrictive when those circumstances tend to be in place. I'll also mention that, because of private mortgage insurance coverage and the fact that the industry has a much better handle on underwriting than it did leading up to the 2008 crisis and immediately following that, there's really no need for these additional charges. So they're excessive, and I think doing away with them would go a long way towards advancing Black homeownership.
Yeah, absolutely. I could not agree more. And just thinking, if the FHA and VA also was essentially, because of private mortgage insurance, it's a duplicate of a fee for coverage and credit enhancement that already exists, and something that doesn't exist within the FHA and VA market. So that alone, I think, would go a long way in increasing borrower choice and expanding access. Michelle, I'm going to turn to you. Vanessa touched on it a little bit with credit overlays, which is another practice that can restrict credit. But can you just expand a little bit more on these credit overlays, and particularly on the limiting effect they have on Black and Latinx borrowers?
Sure, I'd be happy to do that. So I guess I would say the credit overlays, I don't know if they were put in place as much as left in place. Like the risk-based pricing is a new thing, and the credit overlays, the thresholds were always there, but there was nothing to overlay until recently. So here's the thing: the GSEs use these complex automated underwriting systems to predict risk. Their models are calibrated using many years of mortgage data and performance data to predict delinquencies and defaults. There's multiple risk factors, including LTV, which is a loan-to-value ratio, the DTI, debt-to-income ratio, and the borrower's credit score. But now the GSEs basically operate a hybrid system, using both the old and the new. They use a complex automated system together with the thresholds layered on top. Hence the term credit overlay. The credit threshold overlays the automated underwriting system. Here's an example. If a lender or investor imposes, again, the 43 DTI as a credit overlay on top of its automated system, the borrower with a 43 DTI ratio doesn't get the loan, no matter what other indicia of creditworthiness they have, and regardless of what the credit risk predicted by the automated system predicts. So the most common credit overlays are based on credit score, but most pernicious tend to be DTI based. And let me explain why that is. So the DTI overlays disproportionately exclude Black borrowers, even more so than the credit score overlays, which also disproportionately exclude Black borrowers. And that's because Black borrowers are more than twice likely as white borrowers to have loans with DTIs over 50%. And Black families are about 1.5 times more likely than white families to have DTI ratios above 45. So using DTI and FICO in this way as overlays basically double counts them, magnifies their exclusionary impact of just using the variable just in the automated system and on top of it in the overlay. So the mortgage analysts have criticized these overlays because they say they put excessive weight on one single risk factor, whatever the risk factor is in the overlay, which amounts to an arbitrary adjustment to the model. These analysts say the practice of using overlays on top of a well-specified automated system lessens the accuracy of the model and unnecessarily and unfairly limits access to credit. And don't forget, again, it's important, the automated system already weighs the FICO and the DTI among the many variables they use to predict creditworthiness. And so again, that's what the analysts say, that FICO and DTI on top of the model is unjustified weight on these variables in underwriting decisions. And one more thing is, these overlays also have a chilling effect on applications. So when the borrower learns of overlay, they may be deterred from even submitting an application, or the loan officer may deter them as well. So it should be clear then why the FICO and DTI overlays raise present concerns and should be eliminated.
Thank you for that, Michelle. And kind of to expand more on how we can increase Black homeownership, we know the LLPAs and credit overlays can go a long way in helping to expand access or stop the restriction of access. But what about, what can we do that's a little bit more targeted? So what can be done to intentionally increase Black homeownership in the conventional market? And what can we learn from past successes or past shortcomings of current and past programs with the goal of increasing, whether it's LMI or specifically minority homeownership?
So I'm happy to answer that question, Madison. Thank you for it. I would say that Fannie Mae and Freddie Mac are both on the right track with the Home Ready and the Home Possible programs. So these are products that are designed to provide high LTV loans and allow for more flexibility in debt to income ratios, as well as a little bit more flexibility on credit scores for low to moderate income borrowers. However, the typical high LTV borrower with imperfect credit may still not qualify. And if they do, FHA or VA is more affordable, as I mentioned a little bit earlier. So this explains in part why the proportion of Black borrowers in the conventional market is between 1/3 and 1/2 of what it used to be in the early 2000s. So these programs could be improved and expanded, one, by eliminated risk-based pricing in favor of average pricing, and by incorporating more flexibility, even more flexibility in the debt to income risk and credit score requirements. To really move the needle, these programs could be targeted in geographic areas where the homeownership gap is especially high. That is, by increasing their purchases in areas where the conventional market can truly complement the FHA and VA market. For example, both FHA and VA and conventional high LTV lending rates are lowest in Los Angeles and Boston and New York, where house prices are really high and supply is tight. The homeownership gap in these areas, turns out, is not above average. The homeownership gap actually varies from 20% in Washington, D.C., another high cost area, to 41% in Cleveland. The highest homeownership gaps are in Detroit, St. Louis, and Cleveland. So in these areas, you have house prices are relatively low, incomes are relatively low, but you do see sort of higher rates of unemployment. So this suggests that some high loan to value ratio programs, that is, programs that allow for low down payments, may have the most impact in lower cost areas where prospective home buyers are more likely to face challenges in more than one of these risk factors.
Well, thank you. That's really great information. And I think it's worth noting, just to kind of wrap it up, the contrast of everything we've been talking about, and it's particularly what you just mentioned with how we can target minority home programs, with the contrast that has with the recently amended PSTAs, which is the preferred stock purchase agreements. And do you just have any thoughts on the impact that would have if it remains how it is, and how critical it would be for those limits to be removed?
Sure. It turns out that our recommendations to sort of expand these high LTV, sort of low down payment loan programs, this is in direct contrast with the preferred stock agreement adjustments that were made just recently in January of this year. These are guidelines for Fannie Mae and Freddie Mac activities, and they limit their purchases of what they call high-risk loans to no more than 6% of home purchase and no more than 3% of refinance mortgages. They define high-risk loans the same in almost the same way as we are sort of categorizing the programs that are most needed. They are those that have at least two of the following characteristics: either a loan-to-value ratio over 90%, a debt-to-income ratio over 45%, and or a FICO score that is below 680. So as we've been sort of discussing, Black households and homeowners are significantly more likely to present more than one of these three characteristics. Now, my understanding is that there's some discussions underway about removing or reducing these restrictions. And so I am hopeful that they will be revisited, because they really will have, put it this way, they would certainly stand in the way of efforts to expand Black homeownership.
Yeah, certainly. And I'm hopeful too. I really think there are a lot of really positive changes right now happening in the mortgage industry, and brilliant minds like yourself really help push those initiatives forward and give us the tools necessary to make the changes that are needed, and do it in a way that's informed and that can really make meaningful impact. So I think we're coming close to our hour. Do you guys, either of you, have any just quick closing remarks before I send us off?
This has been a great discussion. These have been some really, really challenging questions, but it certainly has been a rewarding experience to be able to look deeper into these issues.
And I just want to thank you for the opportunity to come here and talk about fair housing, how it applies in this context with the GC secondary market. And I think it's an important issue, and I think that really people should focus on it. Absolutely.
Well, I couldn't agree more. And it's been fantastic working with you all and having this hour together to talk through this really critical topic. And just to kind of wrap up, to bring it all together, just kind of the main policy points that we covered today was increasing monitoring and enforcement of fair housing requirements, adopting credit scoring models that look outside existing credit repository data, eliminate credit score/DTI-based overlays and loan level price adjustments at the GSEs, and establish goals for expanding conventional high LTV affordable loan programs that target Black communities. I just want to thank you guys again for this insightful and meaningful discussion on how we can remove barriers to mortgage credit for Black borrowers. This is a topic that is so important and a critical piece in not only closing the Black homeownership gap, but more importantly, closing the Black wealth gap. So I just appreciate your guys' expertise, and I hope that we can all listen in. After we listen to this conversation today, we can take it with us into our workforce and take actionable steps to build a more equitable future. I also am excited, we alluded to this earlier, but we also will be releasing a paper that they have authored in addition to Maquiva Macy, who's a PhD student from Jackson State, called Homeward, Removing Barriers to Mortgage Credit for Black Buyers. So if you guys are interested in this topic and enjoyed this conversation today, I hope that you check out the paper as well. So there's a lot of work to do, but we just got to keep on doing it every day and hopefully get to the other side. So thank you guys so much for your time. It's been absolutely wonderful.
Thank you very much.
Okay.